Good day, everyone. My name is Liaw and I'm honored to lead this presentation on behalf of the Sabah Group. Before we begin our presentation, allow me to acknowledge the hard work and collaboration that went on behind the scene in preparing this assignment and presentation. We are from the Sabah Group, and our team is led by myself, Liaw, together with Charles Au Wei Hon, Rachel Ha Yuan Yi, Kong Xian Pian, Lim Yit Jun, Loy Kok Liang, and last but not least, Tan Yu Hang. We are guided by our lecturer, Professor Dr. Jerome Jayamana. This assignment presents a comprehensive and integrated analysis of two major Malaysian metal manufacturing companies, Press Metal Company A and Chubi Metal Company B. To set the stage, let's briefly introduce the two companies we will be examining. Company A, also known as Press Metal, and Company B, Chubi Metal, are both Malaysian-based entities operating within the metal manufacturing and processing industry. They share several similarities, including their focus on metal-based products, their significant role in Malaysia industry development, and their status as publicly listed company on Bursa Malaysia. Both are also export-oriented and have shown a commitment to ESG principles, though Company A has more established ESG reporting due to its larger size. Our analysis will cover a 3-year period focusing on key financial ratios across 5 categories: liquidity, profitability, solvency, turnover, and earnings. Additionally, we will integrate non-financial information to provide a holistic view of their performance and strategic implications. This comprehensive approach will allow us to draw meaningful conclusions and offer actionable recommendations.
Let's begin with Company A's performance over the 3 years period. Looking at the trends, Company A demonstrates an improving liquidity position, with its current ratio increasing from 1.361 in year 1 to 1.878 in year 3. This indicates a stronger ability to meet short-term obligations. However, a significant area of concern is its declining profitability. We observe a consistent downward trend across all profitability measures, with the net profit ratio falling from 0.091 in year 1 to 0.066 in year 3. This suggests increasing operational costs or pressure on pricing. In terms of solvency, Company A's debt equity ratio has improved from 1.659 in year 1 to 1.157 in year 3, indicating a reduction in financial leverage. Whilst its interest cover remains adequate, we note a slight decline in year 3. Turnover ratio shows mixed performance. While account receivable collection has improved, fixed asset utilization has declined in year 3. Finally, earnings per share have also seen a decline, mirroring the overall profitability trend. In overall summary, Company A's strengths lie in its improved liquidity and better management of receivable. However, the persistent decline in profitability and reduced asset utilization are critical concerns that need immediate attention. The company needs to focus on enhancing operational efficiency and cost management to reverse this negative trend. Now, let's turn our attention to Company B. The financial performance of Company B presents a stark contrast, particularly in its profitability. While Company B exceptionally high liquidity, with a current ratio of 32.138 in year 3, this also suggests a potential inefficient use of its current asset. The most alarming trend is the severe decline in profitability, with both operating and net profit ratio turning negative in year 3. This indicates significant operational challenge and an inability to generate profit from its core business activities. Regarding solvency, Company B maintains a very low debt-equity ratio, indicating minimal reliance on debts. However, its interest coverage ratio has plummeted to a negative value in year 3, a critical red flag that highlights its inability to cover interest expenses from its earnings. Earnings per share have also seen a drastic decline, turning negative in year 3, which is a serious concern for shareholders. Despite its strong liquidity and low debt, Company B is facing a severe profitability crisis. The negative operation and net profit, coupled with negative interest coverage, point to fundamental issues within its operations. The company requires immediate and comprehensive operational restructuring to address this critical concern and ensure its long-term viability.
Let's now compare Company A and Company B directly. The radar chart on the left visually represents their performance across key ratio categories in year 3. We can clearly see Company B exceptionally high liquidity compared to Company A, but also its significantly weaker profitability and earnings. Company A, while facing declining profitability, maintains a more balanced financial structure and positive earnings. Key differences include Company B critical profitability issues versus Company A's positive. Albeit declining profitability, Company B also has a very low debt leverage, but this is overshadowed by its inability to cover interest expenses. Company A, on the other hand, has higher debts but adequate interest coverage. The strategy implications are clear. Company A needs to focus on operational efficiency to reverse its profitability decline, while Company B requires urgent and comprehensive restructuring to address its several financial distress and optimize its excessive liquidity. To ensure a clear understanding of our analysis, let's briefly clarify what this ratio indicate and the possible reason for their performance and movement. Liquidity ratios measure a company's ability to meet short-term obligation. Company A improving liquidity suggests better working capital management, while Company B extremely high liquidity might indicate idle cash or inefficient asset deployment. Profitability ratios assess a company's ability to generate earnings. Company A declining profitability could be due to rising raw material costs, increased competition, or operational inefficiency. Company B negative profitability in year 3 is a sign of several operational problems. Possibility due to poor sales, high fixed costs, or intense market pressures. Solvency ratio evaluates a company's ability to meet long-term obligation. Company A's stable solvency indicates a management debt load. Company B low debt is positive, but its negative interest coverage highlights that even with low debt, it cannot generate enough earnings to cover its minimal interest expenses, which is a critical solvency risk. Turnover ratios measure asset utilization efficiency. Company A mixed turnover suggests areas of improvement in asset management. Company B's overall lower efficiency indicates it's not effectively converting its asset into sales. Earning ratio reflects shareholder returns. The declining EPS for both companies, and especially the negative EPS for Company B, signal a reduction in value for shareholders, likely due to the profitability challenge faced by both entities.
Moving beyond financial numbers, environmentally data is increasingly influencing investment decisions for companies like Press Metal and QB Metals. Operating in resource-intensive industry, environmental performance is a key indicator for investors. Strong environmental data can signal lower regulatory risks as companies with good environmental records are less likely to face fines or operational disruptions. It also points to operational efficiency as reducing waste and energy consumption often leads to cost savings. Furthermore, positive environmental data can enhance a company's reputations, attracting environmentally conscious investors and potentially lowering the cost of capital. It can also drive innovations, opening new growth opportunity in sustainable practice. Conversely, poor environmental performance can lead to reputational damage, higher regulatory scrutiny, and limited access to capital. Our analysis assumes that ESG factors will continue to grow in importance for investors and that environmental impact is material to this company's financial performance. Community engagement efforts are crucial for both companies and their stakeholders. For companies in the metal manufacturing sectors, maintaining a positive relationship with local communities is essential for securing their social license to operate. This means gaining and maintaining the acceptance of local communities for their operations. Effective engagement mitigates risks such as protests or legal challenges which can disrupt operations and damage reputations. Beyond risk management, strong community engagement enhances a company reputations, making it more attractive to customers and employees. Employees in particular often feel a greater sense of pride and loyalty when working for a socially responsible company. Lastly, good community relations can facilitate access to local resources and talents, creating a more stable operating environment. We assume that the operations of this company have a direct impact on their communities, and the stakeholders are increasingly aware of and concerned about corporate social responsibility.
Non-financial reporting, particularly ESG disclosures, significantly impacts a company's reputation. Transparent reporting builds trust and credibility with all stakeholders, from investor to customer. For Company A, its established ESG reporting reinforces its image as a responsible industry leader. For Company B, developing its non-financial reporting will be crucial to close any perception gaps. Robust non-financial reporting attracts and retains investors who prioritize sustainability, potentially lowering the cost of capital. It also enhances customer and employee loyalty, as consumer and talent are increasingly drawn to companies with strong ethical and environmental practices. Furthermore, it strengthens relationships with regulators and can provide a buffer during reputational crises. Our assumptions here are that stakeholders actively scrutinize these reports, that the reporting is authentic, and that these factors are highly material to the company's long-term success. In conclusion, our analysis reveals distinct performance profile for Company A and Company B. Company A, Press Metal, demonstrates a stable financial position with improving liquidity, but faces challenges with declining profitability. Its established ESG reporting provides a competitive advantage. Our recommendation for Company A is to focus on operational efficiency and cost control to reverse the profitability decline while maintaining its strong market position. While for Company B, True B Metal is in a critical financial distress, marked by negative profitability and earning, despite its high liquidity. While it has very low debt, its negative interest coverage is a serious concern. For Company B, we recommend urgent and comprehensive operational restructuring to address its profitability crisis and optimize its excessive liquidity. Both companies should continue to enhance their non-financial reporting, focusing on environmental impact, community engagement, and governance to build trust and ensure long-term sustainability. Thank you.